Welcome boys to a quick recap of the trade that I took today on NAS100 using the full Mech variation of the top and barrel model. This made me around 5% on all of my funded accounts that trade the Mech model, and as the name implies, this model is fully mechanical. There is zero discretion at all in this model, and in this video I'm going to talk through exactly why I took the trade, how I got the bias, how I did the entry confluence, and exactly why I did everything. So starting off with the bias, I go to the 4-hour time frame, and this is the easiest part of the entire model, and it is the easiest way I've found to determine bias in any model ever. Is you hop onto the 4-hour time frame and you look for the most recent break of structure to a fractal. What is a break of structure? It's a candle close above a high or below a low. So we look for the most recent fractal right here. If you don't already have the fractals indicator, you click on the indicators here and search for fractals by Rachel T. It's this one right here. As soon as you've got the fractals indicator on, look for the most recent fractal. Was there a break of structure? So was there a candle close above this high? No. Then we go to the next one, which is this low. Was there a candle close below this low? No, there wasn't. Go to this one. Yes, there was. You draw this little line across. There was a candle close above it. And for our case, that means that we are bullish for this trade. So as soon as you hopped on the 4-hour time frame and you've established these fractals, look for the most recent break of structure. If it's to the upside, you're bullish coming into London session, and if it's to the downside to a low, then you're bearish coming into London session. As soon as you've established your bias, you come into the session. So for us, we're coming into London session right here, and we are looking for the previous session low to get swept. The whole point of this model is we've established we're in an overall uptrend. We're then looking for price to come down, sweep some liquidity, give us a few extra confluences, and then rip to the upside, just like that. So we need to get the sweep of liquidity first before we continue moving up. So we're looking for a previous session level sweep. We need to look for the lowest point in the previous session, which was Asian session. So I mark out Asian session right here, which is from midnight UK time all the way up until London session open, which is 8 o'clock right here. I mark out the lowest point, which is this point right here. And all I do is I wait until we get swept. If we don't get a sweep, we're not taking a trade. We just wait for the sweep to happen. So I'm going to fast forward price and we get the sweep right here. Then we're on to the next confluence. The next confluence is what is called a fake out. Now this is a confluence that quite a few guys get confused on, but it's actually not very complicated at all. The whole thing we're trying to do here is avoid the fake move up that often comes with an actual move down. So the whole kind of premise of this model is we get the sweep, then we want to avoid getting in too early, because what will happen is as soon as we've swept, there will be people that get in super early. There'll be like a 1 minute break of structure or a 30-second inverse fair value gap, and a whole bunch of people will get in right here. And what will happen is the market will stop them out and then continue. It's called like a stop hunt or a stop raid or something like that, some discretionary shit. And the whole thing we're trying to avoid is getting in too early, because then we just get stopped out. So for us, we need to look for a bit of a confirmation to the upside and then a stop out on there. So what happens usually is we get the sweep and then we'll have a fake move up. And the way that we identify this fake move up is by looking for the first bullish candle or the first candle in the direction of our bias on the 5-minute time frame. So as soon as we've had the sweep, we're looking for the first bullish candle. And then to get the fake out zone, we need this little zone of where price is going to tap in. We use the fib tool and we draw it from the highest point in the previous session and the current session combined to this sweep. And if we were the other bias, we would do it the other way around from the lowest point all the way up. So for us, the highest point in this session is right here. So I'm going to draw this all the way down to the lowest point of this bullish candle, which we get right here. Now this has given us a little fake out zone. So you can draw a little box here, or you can leave the fib on, whatever you want to do. For me, I'm just going to draw this box and then get rid of the fib so it's a bit clearer. Now what I'm looking for is a tap back into this zone, because what we've done here is we've swept liquidity, we've moved up a bit, and we're looking for a tap back into this zone to stop out all the people that got in too early, and then we can rip up in that direction. So I'm now just going to wait for a tap back into this zone. And you can see right here on the next candle, we get this wick into this zone. On the 1 minute time frame, this might be a little bit clearer, as we've moved up and then tapped back in and then continued to move up. So as soon as we've got the fake out, we can then remove this fake out zone and we're ready for the next part of the model. The next part of the model is a break of structure to a fractal for the 5-minute. Now, this is the confirmation. This is, we've had the sweep, we've had the fake out. Now I want to see if we're actually ready to move in the direction that I think we're going to move, which is obviously to the upside because we're bullish. So for the break of structure to the fractal, we need exactly the same as the 4-hour. We need the most recent fractal to get broken. So all you do is you draw a little line on the most recent, and maybe you set an alert on it if you can't be on your phone the whole time, and you wait until we get that break of structure. So I'm going to play price all the way through, and now we've got a new fractal. So we move it down to here. We're waiting for the new fractal. And we do the exact same thing. We wait for this fractal to get broken. If we get a new one, which we get right here, that is now the new one, and we're waiting for that to get broken. And you continue doing this until you get a break of structure. Now this doesn't count because we need a candle close above the high. So this little wick doesn't count at all. So it's still valid. We can still wait for a close above it, but this little wick is not what we want. So I'm still going to wait. We've got a new fractal, so I'm going to move that up here. And this is what you're doing the whole time, is just waiting for a candle close. Again, this wick doesn't count. This gives us a new fractal. And that was a phantom fractal, so that's one you need to be a little bit careful of, is when there's a fractal and then it disappears, you need to be a little bit careful. But for us, we've got this bullish candle close through this candle right here, through this fractal, sorry. So this has given us the break of structure and we're ready for the actual entry of the model. The entry, again, super simple. The fib tool does all of this for us. We are going to draw a fib range from the lowest point of the sweep all the way up to the highest point right here. I'm going to get rid of the break of structure line so it's a little bit clearer. And this has given us this magical zone right here, which we call the Goldilocks zone. So you need to place a limit order, which is when price taps this zone, it's going to enter you into a trade on either the 0.5, the 0.618, or anywhere in between. I always choose the 0.618, and that's what I'm going to kind of advise you guys to do, but obviously do your own back testing on it. You can enter on the 0.5, that'll give you a lot more entries, but they're not going to be as high quality entries. Or you can enter on the 0.618, which is going to give you less entries, but they're going to be much higher quality entries. So for me, I enter on the 0.618, so I'm going to put a limit order on the 0.618. I'm going to put my stop loss on the 1.025 line right here, and then I'm going to target a fixed 3R every single time, right there. And now I'm going to wait. And price is going to come down. And if price extends the range right here, that's no problem at all. You just draw it up here. You draw it up to the most recent one right here, and that has obviously changed your limit, so you now need to move that up to the 0.618 and adjust your stop loss, and this has reduced the R, so I need to move this back up to 3, and you continue to do this until you get a tap in. So for us, right here, we get a tap. So now I'm entered into the trade. As soon as you get this tap on the 0.618, you're now entered into the trade, and you set and forget. That's the most important part of this model, set and forget. Don't manage it, don't move to break even, don't trail your stuff, don't do any of that stuff. Just leave it. Let it either hit SL or TP, and your results will be so much better, especially if you're emotional. Don't even try and trail it if you're emotional, just fully leave it. So you're going to wait, and we're just going to play price out and see what happens. And it rips all the way up to take profit. That is a tap and barrel model. That is a tap and barrel setup right here. You obviously could have targeted more. You could have trailed it if you knew what you were doing. But for the most part, just set and forget. That's going to have a lot more benefit to you. Because there will be times, and this has happened so many times, is it will get to 2.8. Then it will smack down to break even, and then it will rip to 3. And if you got emotional, if you went risk free and you put it here on the break even, you're going to regret it, because we've done the maths and we've done the back testing. The times where you get stopped out of break even and then it runs to TP, you lose more R than you save by moving it to break even. Do the back testing yourself, but that's what we found out. So that is the entire model right there. Super, super mechanical. Only has like 5 confluences or something like that. And the bias is so, so simple. So definitely get on this model. It's super, super simple, super mechanical, super repeatable as well. And the backtested data is definitely very, very strong on it. So that was all for this trade recap. Hopefully you guys enjoyed it, and I will see you in the next one.